I'm not sure who the author of this statement is, but I think there's tremendous value in understanding what it means. Turnover is vanity. And when talking about turnover, obviously we're talking about the sales in the business. And I often hear people talk about how much sales they're generating. And of course, we've got to convert those sales or the turnover into profitability in order to find some sanity in our business. But the one thing we're going to find out shortly is that profitability is not enough. Profit needs to be turned into cash flow for a business to be able to survive. So it is about the reality of a business is understanding the cash flow. So let's explore some differences between profit and cash flow. Now we've spent some time on the income statement, which is obviously where we find profit in the business. But it is possible for a profitable business to go bankrupt. And by going bankrupt, what we really mean is that the business is run out of cash and it cannot pay its suppliers or its staff or any other creditor of the business. So I want to explore why the income statement is not a good statement or good set of numbers to use to understand the cash flow. So first of all, sales at the top of the income statement includes both cash and credit sales. And credit sales by their nature are sales that we make today, but the customer pays us in the future. So if most of our sales are on credit, it does mean that we haven't received the money from our customer, and therefore any profits aren't actually cash in hand because we haven't received the money. The business might also be spending money on investing in new assets. That might be through acquisition of businesses or investing in new capex projects, and those capital expenditures are not shown in the income statement. We only show the depreciation portion that relates to the capital expenditure. So there can be large cash outflows that are not seen in the income statement. In the income statement, we expressly show the interest expense, but what we don't show is the capital repayments, as I've called it here, the debt repayments. So large cash outflows that repay debt are not shown in the income statement. So there's a few items here that are not in the income statement, so therefore it shows us why the income statement is not the greatest predictor or much use when it comes to cash flow in the business. So this thing called profit is actually an accounting term, whereas cash in the bank is the reality in a business. So given that we have these shortcomings in the income statement, let's go and have a look at where in the business do we find cash? How does cash appear? And I'm going to talk here about 5 different sources of cash flow. The first one being cash from operations. So here we're going to go and find the operating profit from the business, and we're going to add back some depreciation. And I'm going to explain that add back depreciation in some more detail later on when we actually do the cash flow numbers. Just for now, to recognize that depreciation is a non-cash expense. So hence we need to make that adjustment when we are unpacking the cash flow in the business. So cash from operations is the first source, and that's literally money that we received from the customer for products and services that we've sold. Then we have cash from working capital. So here we need to go and look at these components, the debtors, the inventory, and the creditors in the business, and understand how they're changing from one time period to the next. So specifically, I'll use one as an example now, and we'll get into the details of these a little bit later on. But for example, the debtors, when we did our fully worked income statement on our printing business, we looked at this concept of debtor days. And I showed you how if you change the debtor days from 30 days to 60 or 90, It meant that the amount of debtors went up. In other words, our customers owed us more, and the amount of cash in the business went down. So understanding how that changes from one time period to the next is critical in our understanding of cash flow. So the next item is investing activities. And in this case, we're looking at the purchase or sale of fixed assets in the business. Typically, this is the CapEx budget. And obviously, if we're selling assets that the business no longer uses or requires, that's going to bring money into the business. It's going to be a cash inflow. And if we're purchasing, it's going to be a cash outflow. The fourth source of cash is cash that we get from financing activities. And here you can clearly see it's acquiring new debt from the bank. So if you borrow money from the bank, that's going to be cash in. But if you are repaying debt to the bank, that's going to be cash out. And of course, interest payments are going to be cash out. And the last source of cash that a business has available to them is, of course, to go to the shareholders and ask them to invest new capital into the business. Obviously, that's a cash inflow. But in times where a business has excess cash, it might choose to give that money back to the shareholders in the form of share buybacks and dividends. So that's a quick overview of cash in a business in terms of how the income statement has its shortcomings and where the sources of cash are in a business if we wanted to go and measure and find out what the cash inflows and outflows are. In the next video, we are going to look at some specific numbers around the working capital. That's the debtors, inventory, and creditors, so that we can understand those rules. See you in the next video.